Hello! Today we're going to be talking about the double declining balance method for depreciation. Now this method is what we call an accelerated depreciation method, meaning that it records higher depreciation expense in the earlier years, for example year 1 and 2, and lower depreciation expense in the later years, for example years 3 and 4. And the way we do this is in two steps. First we find the double declining rate, which is 100% divided by the useful life in years multiplied by 2, and then we find the depreciation expense by taking that rate that we just calculated and multiplying it by the previous year's book value. So this question says, on January 1st, 2009, Mr. Ed's Consulting Services purchased a company vehicle for $25,000 with an estimated 4-year useful life and a $3,000 salvage value. We are asked to calculate the depreciation expense, accumulated depreciation, and book value for the 4 years of the vehicle's life. And we're going to do that in this chart that we have here. So the first thing we should do is just copy down the relevant information. The cost is $25,000, the salvage value is $3,000, and the useful life is 4 years. Now to calculate the rate, we need to take 100% or 1, divide that by the useful life, which is 4 years, and multiply that by 2. And that tells us that the double declining rate is 50%. Now to find the depreciation expense, we have to take that 50% and multiply it by the previous year's book value. Now in year 1, the previous year's book value can be found by taking the cost minus accumulated depreciation. But remember, we've just gotten this asset and we haven't even recorded any depreciation yet, meaning the accumulated depreciation is going to be 0. So the book value in year 0 is just going to be the cost. So we can take the double declining rate of 50% and simply multiply it by the cost. You should always be able to do that for double declining balance. The first year depreciation expense is really just the double declining rate multiplied by the cost. Alright, so we have $12,500 for depreciation expense. That will be the same thing for the accumulated depreciation, remembering that this column just adds up the depreciation expense up until that year. And the book value is just going to be the cost minus accumulated depreciation. So that's $25,000 minus $12,500. Alright, year 2, we can take the double declining rate again, 50%, and multiply that by the book value in the previous year to get $6,250 of depreciation expense. The accumulated depreciation is, well, the sum of the first 2 depreciation expenses together, which comes to $18,750. And then the book value will be, once again, the cost minus the accumulated depreciation. Alright, I'm going to give you a minute now to maybe on your own pause the video and see if you can get the last 2 rows of depreciation expense, accumulated depreciation, and book value. And then we can talk about what we have to do with it. Alright, welcome back. So once I filled out the chart using the rules that I laid out for the first 2 years, this is the chart that I got. You should notice something. You should notice that the book value in the final year is $1,563, which actually is lower than the salvage value. So what we end up having to do is make an adjustment here. So we need to clear out this last row and change the book value to the salvage value, since we can't depreciate below that amount. And then what you're going to do is you're going to take the difference between the book value of the previous year and the book value of the current year, and that's going to become your depreciation expense. And then you'll just calculate the accumulated depreciation just like normal. Alright, so now we are finished with our chart. So this shows that we started this with an asset that cost $25,000, and over the 4 years we depreciated it using the double declining balance method, eventually to get down to a book value of $3,000, which is the same as the salvage value. And you'll notice the accelerated part really did work here. We have very high depreciation in the first 2 years and much lower depreciation in the last 2 years.